Hello, for this homework and data visualization, I decided to do a project where I looked into hedge fund data. Specifically, I looked at 13 hedge fund strategies that were tracked by EDHEC, which is the European Business School, over the period of 1997 to 2008. And what I wanted to see are kind of a few different things that I'll get into, but generally kind of trying to figure out, what are the best and worst strategies and what insights can we kind of gather about as well, and how the time period that these returns were generated in, either positive or negative, can shine a light on an investor's ability to sort of produce these returns in the future. So here's sort of our graph, and we'll talk a little bit about it more in a moment. But essentially, it's a line chart with each of these lines representing the performance, the returns of these hedge funds on a percentage basis, on an annualized basis for the analysis period. So looking into sort of the initial thoughts that I had, the two thoughts that I had, which inevitably were kind of proved wrong to an extent, were the fact that if a strategy was more focused on, capitalizing on a specific scenario, such as fixed income arbitrage trading or event-driven trading, and to some extent global macro trading, the more volatile the returns will be. And the more someone's focused on diversification, they might not have the most huge returns of periods, but they'll have the most consistent positive returns. And then the second one I thought about, which kind of was true, was that certain strategies will have really strong outsized returns during market downturn, but in most periods, they'll have more depressed returns. So talking about our attributes a little bit here, I had three different attributes. So we had our fund strategy, which is a non-ordered categorical variable, or the date, which is it's actually a quantitative value, and the ordering of it is sequential. And for our returns, it's another quantitative format. It should be as a percentage, although for our data, we had to put it in as just a nominal number, so it fit into our analysis. And then the order is diverging with a midpoint of 0. And so in terms of the user's task and data, the individual, someone looking to start a hedge fund who wants to invest in a hedge fund, or a retail trader looking to figure out the best strategy would be the user. We had two different tasks. So one would be to determine which strategy is the most consistent return during the period, and then which one has the lowest returns during the period. As I mentioned, the data is from a Kaggle data set, and then did a little bit of manipulation. We won't talk too much about that. And then sort of diving into our insights here. And so what I actually found, the first one is that short selling is the worst performing strategy during the long term. While it did have a few years as the best strategy, most of these were during 2008, 2009, when there was a huge market collapse. And so when we think about short selling, which is a bet on the price of a stock going down, it's actually, we can see that, it's one of the best performing strategies when things are going wrong. But generally, things do decently well in the market. And after 2008, 2009 was actually one of the worst strategies. Now looking at our graph here, or visualization, I should say, this red line here represents short selling. So as you can see, during the 2008 or so period, it had huge returns, but since then it's actually been one of the worst performing strategies as the bull market has continued. So that's our first insight. Thinking about if it's meaningful, it is meaningful because users get a powerful warning that it's a bad strategy most of the time, and it would be difficult from a deep understanding perspective if it hadn't been visualized to actually see over 21 years that this wasn't the greatest thing to do. It's also not really obvious because it did have, as I mentioned, a few years of good performance, but without seeing it all laid out on a time series basis, it's harder to see that it's actually usually a pretty bad strategy. Obviously, it's meaningful because people can prevent losing money, and it's actionable because they could, because they can not use a strategy and avoid losses. That's our first insight. Another insight is that event-driven strategy is probably the most consistent strategy. While if we look at it initially, this yellow line here, we may see that it's not actually super duper outperforming in many of the years. However, when we look at the data in more detail and more granularity, we can see that actually in 21 years analyzed, only 4 of the years had a negative return. And the biggest negative came in of 18% was in 2008 during global financial crisis, but actually went back to about 26% in 2009. So what we see is that many other fund strategies are having bigger years of specific individual success. However, as an investor, it's important to realize that compound returns and interest, is the most powerful thing we could look for as an investor. So what a successful investor should be looking for is something that's repeatable, easy to implement, and something that can generate returns consistently over the long term. And it seems though event driven is delivering these consistent, easy returns. And I think when we look at my example insight, this is actually contradictory because this is a strategy based on investing in specific events rather than a more diversified approach to investing. I think there's a few phenomena that can kind of cause this. So, while some of these longer term fundamental strategies do perform well, they're kind of taking a longer dated bet on the value of some stocks. And so, while they're waiting for these investments to pan out, they might not see huge returns in those years, and those longer dated bets might not pan out. However, with event driven, we could think about the fact that they're looking for specific events, such as earnings or such as specific repeatable things a lot of times, or even one-off things that happen in the market. And there's a lot more of those going on. So what that provides for those hedge funds is a more repeatable strategy because there's more investment entry points. However, it is important to note that for the 2 years of someone looking to start a hedge fund or invest in one, they could probably do this approach because they have the resources to sort of find and research these events. But a retail investor may not have the same amount of time and resource to properly execute the strategy, so they should proceed with some caution. Those are most of the points that get hit on. One other thing to hit on briefly is sort of the marks. So there were line marks used for the strategy attribute, and they were encoded with the color channel as well as the opacity channel on the lines to help users differentiate between which lines they're actually looking at to focus on specific strategies' performance while still seeing the other ones in opaque fashion. For returns, I used the mark of for lines as well there, and then the x-axis was kind of encoded with the tick marks. So the y-axis was encoded with tick marks to see the returns of each strategy. Date was encoded with marks on the x-axis with horizontal spatial positioning channel. That's it for the analysis, and I appreciate you guys listening.